Hello, 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 everyone. Larry Bailey here. Welcome to another Live with Caeli show. We're here with courtesy of Ridge Lending Group. And as I always like to remind folks, Ridge Lending can always be reached. You can call toll free at 855-74-RIDGE. You can email info@ridgelendinggroup.com. You can walk in if you happen to be in Portland and check the place out and sit down with a conversation with Caeli yourself or any of the other dedicated lending specialists that you might be connected to. So today is Tuesday, June 21st. And as always, these calls happen on Tuesdays, 4:30 p.m. Eastern, 1:30 p.m. Pacific. And we get together to talk about what's happening, go over some open Q&A, talk about market conditions, figure out the best way to help you into your next investment, and talk about investment strategies at large. So I'd like to welcome Caeli.
Hey gang, I'm off camera today, but I'm very excited to be here with you as usual. I think we've got some good takeaways for you all today. Larry's going to kind of lead the charge, and I'm going to speak and impart hopefully some fresh new ideas and thoughts about real estate investing that may apply to you and your certain set of circumstances.
And the birds are chirping in the back, which tells me that Caeli's off looking for her next investment property. No, I'm kidding. But we always want to be looking for the next investment property. So that's really the topic of today's discussion is just how does Ridge Lending Group help you find the answer to your financing for your next investment property. One of the things that I know we continue to see, Caeli, I'd love for you to speak to, is that Ridge Lending is not your Amazon, right? So I think of Amazon, I don't know about everybody else, but I think of Amazon as when I'm looking for something and it's the cheapest thing and hopefully it works, I read some reviews, and as long as it's not overwhelmingly negative, I'll take a chance. You definitely don't want to take a chance on your personal investment strategy. Everything should be worked out. And one of the things that I've come to love with Ridge, as have everyone who ends up working with Ridge, is the ability to find a way to get the next investment completed and closed and keep it in line with the overall strategy. Is that what you've found over the years, Caeli?
Yes, my technology was doing some tricks on me, so I think I heard the question. But it's an evolution, you guys, right? And as you change and evolve as real estate investors, our availability of education and access to credit loan programs continues to evolve with you. So I'm always telling our new clients or prospect clients that we are not a one size fits all, right? We have an extremely diverse menu, as I like to call it, of loan products that don't just start and stop with a conventional Fannie Freddie. Non-QM, commercial products that can apply to residential loans, bridge loans, debt service coverage ratio loans, bank statement loans, asset depletion loans. It's very, very wide ranging. And in fact, we are extremely hard pressed. I cannot remember, Larry and I were talking before we started the podcast, I cannot remember an instance where we were not able to secure funding for an individual because either the property didn't work or their qualifications we didn't have a home for. I mean, it would be very difficult for me to try and pinpoint when the last time that happened. It's probably 1 in 10,000. Maybe that's even not enough. It might be more than that.
Yeah, I know that when I go through and we see borrowers don't intend to continue with, it's usually a property falls out or something happened with assets. Right now that's a big, I know it's a big concern with some of the changes in the equities. So Caeli, when you do look at those custom solutions, I do want to just, for everybody who's joined here, this is always an open Q&A. Caeli and I try to guide the conversation along with some particular topics, but if you ever have a question, go ahead and take yourself off mute. Or use the chat feature within the Zoom meeting, and you can ask any question that you like, especially if you've got a specific scenario. So when you go through, Caeli, and you're looking at the ability to use some of these custom solutions outside of Fannie Mae, Freddie Mac. Is there any commonality for borrowers that really should consider not using Fannie, Freddie besides the 10 property rule?
Sure. Let's say that you've got an individual, just as an example, one-off example, who's got a fairly robust portfolio, and it's stabilized. They've had these properties for 3, 4, 5+ years, maybe looking at some kind of a non-recourse commercial loan, right? Where we'll take multiple residential properties, single family up to 4 units, and cross-collateralize them into one blanket commercial loan under a non-recourse, which means they would not have any personal guarantee tied to the loan. That would, one, open up conventional loan spots for them if they wanted to go back and utilize that. Perhaps the individual is far too complicated. We've got a client right now who's got, I think it's 32 properties, and for him to go through, and many of them aren't financed. I think he could actually legitimately qualify conventionally, but for him to go through the brain damage of vials of blood and DNA samples, you guys have heard me say that, which is what Fannie and Freddie require, doesn't make it worth him. So looking at it from, let's say, the debt service coverage ratio loan perspective, where we're really just looking at the property itself and the gross rents divided by the mortgage payment, for him to look at that scenario and what the interest rate is, because it'll be higher, right? The less skin you have in the game as an individual and qualifying with income documents and tax returns and things, the higher the rate's going to be. So for him, he's looking at it, and time is money. The interest rate for the debt service was, I think, 1.25 higher than it would have been conventionally. But to get through the gauntlet of trying to secure 4 or 5 mortgages for somebody like him is just brain damage he wasn't interested in enduring. So it made more sense, even though he lost, $100 of cash flow for these today, keeping in mind he knows that his real estate portfolio is a long-term play. He'll catch that back up. Made more sense for him. So that would be a good example. Similarly with a bank statement loan, where instead of looking at tax returns, the individual is self-employed, and I can relate to this. I'm going to do everything I can to mitigate as much as I can the amount of taxes I have to pay. So on my tax return, I'm going to show a smaller adjusted gross. But my bank statements, my business bank statements, are going to show the depository income that says, or speaks a different message to an underwriter that says, yes, I can qualify using this source of income based on a debt to income ratio threshold. So I think that answers the question. I think everybody's individual circumstances are going to be unique, and looking at that together with them and determining what the best course of action or loan product is going to be for them is the way we want to attack it.
And for those that are joining, when you look at yourself, right, or those that are around you in terms of qualifying for an investment property, is it if you don't mind giving some feedback here, is it the loan program that usually strikes you as the most difficult part, or is it the scenario, or is it just you just don't have the cash ready for the next investment? Does anybody want to take a stab at that choice? Because that's typically, out of the groups that we speak to, everybody wants to make the next investment. They want to grow their portfolio. But typically what we find is it's usually they don't have the cash ready at the exact moment, or they can't find an investment that quite meets their template they're looking for. Any particular feedback from the group that's on the call today? So Caeli, in your, if anybody does have a comment, please go ahead and jump in. But Caeli, from a loan program perspective, from products that are offered, like similar to what you said earlier, it's not necessarily finding a place. It's finding a loan program rather that meets the outcome the borrower needs. It's typically something outside of our control. So Donna's like, hey, don't have the cash. So part of what we've been talking about before, Caeli, is when somebody doesn't have the cash, what can you think of in terms of recommendations, other places that they might be able to Like if they don't have the liquid funds, but maybe they have other assets, what are other things you've seen investors do creatively to help create opportunities for the next investment property purchase?
Yeah, there's a few different components here that I can speak to. One could be a JV, a joint venture, right? You've got, maybe you're part of a forum or a chat room for fellow real estate investors. Everybody's circumstances are inherently different. Let's say that Mr. Jones has lots of money, but he can't qualify, right? You don't have any money, but you've got all the qualifications. So a joint venture together would make perfect sense, right? He's got the cash, you've got the credit and the debt to income ratio, JV. We could look at sort of a Burr method where unsecured lines of credit could be used. Now, this is a little bit more complicated. Maybe I'll save that for the third one. I'll come back to that one as the last one, because that's a rabbit hole.
Okay.
But other assets, right? If you've got a property, a primary residence, for example, and I've been talking about this a lot lately. Top of mind is interest rates. Everybody knows that they're going up. And I'm looking at it, and most of you, I think we talked about this last week when we were talking about do the math, people, do the freaking math, please. If you've got equity in a primary residence or another rental property that you think you don't want to tap into because the interest rate is 2% or 3%, well, maybe that's a viable stop for you, right? Maybe that makes sense, but maybe it doesn't. Have you run the math to find out? Because honestly, guys, if the interest rate is going to be replaced, let's say you've got a 3% interest rate on a rental property, and you're going to be putting it into a 6% interest rate today to harvest that equity that's sitting there doing nothing for you. Have you done the math? Or is it just a psychological stop that says, I'm not going to replace a 3% interest rate on a 30-year fixed with a 6% interest rate because what? Why? Will it still cash flow would be the first thing that I would ask you, right? When we're looking at doing the math together. And if the answer is yes, let's take it a step further. How much equity can I harvest, right? Then we take it a step further. Based on that number, I'm going to go and deploy that out for more returns and investments, whether it be, more single family residence, or it be a 2 to 4, or it be a short-term rental, or maybe a syndication, or maybe you're going to lend your money out to another investor at a higher return, whatever it may be. What's the return on this dead equity that's sitting there doing nothing for you? Is it going to cash flow with a higher interest rate? And when you get the cash, will that make up for the loss of what you're doing over here? And then after all of that's determined, you got to keep looking at your appreciation of the property, your tax benefit of the property. Here's another good example. When we start talking about the tax implication on a Schedule E, the interest that you pay is tax deductible, right? There's an incentive there. Is the interest higher at 6%? Are you deducting a higher amount of interest at a 6% interest rate or at a 3% interest rate?
Ooh, I know, the higher.
Right. So just make sure, you guys, the holistic approach here, you have to be doing the math and looking at it from all of these different facets to make sure that you're making a wise decision. Now, maybe at the end of the day, after you've done all that, it doesn't make sense to do a cash out refinance, or maybe it does, but make sure that you're preparing yourself with facts and not a psychological block that says, no, I'm not going to do this just because 3% sounds less than 6%. That is not the way you should be looking at your real estate portfolio. Let me jump right into other ways that people can get into real estate that they may not have the cash to do today. So the Burr method: buy, rehab, rent, refi. Now, it may not even require any rehab, right? That might not even be part of the play. But what people can do, what investors can do that do not have their own capital, they don't have equity sitting somewhere in another property, or they're not interested in doing a JV or whatever it may be, if you can qualify, you can go out there and get unsecured lines of credit, okay? These are credit cards, you guys, and there's companies out there that supply this service. One of them that I'm familiar with is called Seed Capital, SEED Capital. There's no affiliation. Rich doesn't have any affiliation. I know of this group, where they'll go out and for qualified individuals, they'll get $100,000 of unsecured lines of credit. Let's say it's 5 credit cards of 20 grand a pop. And these introductory 0 interest for 6 months or 12 months or 18 months, right? Stay with me here. They're going to draw down the entire 100 grand, right? They're going to max out the cards, the lines of credit, because it's 0 interest. They're going to take that cash and they're going to go buy a piece of property for cash. Then they're going to come back to Ridge and they're going to do a cash out refinance. They're going to, at 75% on a single family of the appraised value, they're going to take that cash and they're going to apply it to pay back the unsecured lines of credit. Now, chances are there's probably going to be a balance left over of what they used to purchase the property versus the cash out that they've paid those lines of credit back with. Let's say it's 20 grand, right? So they keep $20,000 out there, and maybe the interest starts to kick in, whatever. Well, now they've got a tenant making the mortgage payment and then some, $200, $300 a month cash flow, whatever it is. They're going to use that to rapidly accelerate the payoff of that remaining 20 grand, right? So there's all kinds of ways to skin the cat, lots of creative, lucrative ways that you can utilize other people's money, right? OPM, other people's money, leverage, do the math.
Caeli, I'm going to ask you a question. And for this is not like stage, like she and I have never talked about this. So in the Burr method, I don't know if I got away with this as a one-off lucky thing, but when I use that method, I actually put a lien against the property with one of my LLCs at the time of purchase. So it became a purchase money mortgage. And then I was able to do a rate and term refinance because it was recorded mortgage against it and it paid back my LLC the full amount. Have you ever heard that?
Perfect. Absolutely. Yeah. And for those that are a little bit more sophisticated and they've gotten through this and maybe they've already established their LLC and there's capital in there, that's a perfect solution to getting unsecured lines of credit. So if your LLC can float the acquisition, okay, you record a lien. And instead of it being a cash out refinance, which comes with some additional restrictions under conventional guidelines or really any guideline, a rate and term allows for higher leverage. It allows for speed because you're not taking cash back in hand. You don't have to have that seasoning if we're just simply replacing one loan for another loan. Beautiful. Absolutely love it.
Yeah, I totally it never occurred to me that was something special until I'd heard that other people aren't doing it. I'm like, why aren't you doing that?
Yeah.
Okay. Well, that's fantastic stuff. And again, if anyone has any questions, comments, scenarios that you want to walk through, go ahead and feel free to take yourself off mute or go ahead and feel free to put it in the chat. And if you're listening to this on our podcast, replay in the community, wherever in the universe, feel free to join the conversation in the community or let us know how we can help you out with some of these scenarios. Can you think of, Caeli, as a lot of these programs, these loan programs that you and I kind of laugh about over the, week over week about how, there's no such thing as a no doc necessarily anymore, but the ability to document your investment property's ability to repay that loan with bank statement programs or debt service coverage ratio loans. Is there anyone in particular, any scenario recently that stands out as a thing that you wouldn't have been able to do or thought about doing a year ago for a client?
I would say that the debt service coverage ratio is becoming more prevalent as time goes on, past 08, 09. For those of you that were around then, you know that in 2008, 2009, we had a very significant change, implosion, let's call it, of real estate, housing, and lending. So as a result of that, the irresponsible lending that happened prior, we didn't subscribe to any of that. Ridge didn't get involved in that. But as irresponsible as some of the loan programs were pre-08, 09, there was a knee-jerk reaction, and post-08, 09, everything stopped. There was nothing available, even to credit-worthy individuals. So, I think history, I don't know that I'm going to say that it would repeat itself, but people have short memories. And I'm seeing some new loan programs come out that I think have a measure of responsibility. And I think that the debt service ratio in particular is a way that an investor, right, like Ridge or whoever's going to be funding the deal, can feel confident and comfortable that the asset itself can cover the debt, right, that you're going to be placing on it. So I think that there's some really great, and interest rates are, while they're going up, I'm starting to see the difference, the margin between, say, a conventional rate mortgage and a debt service ratio mortgage, that margin between interest rates is starting to narrow a little bit. So there may be more incentive. Yeah, more incentive for investors to look at that as a means of funding their next investment.
Especially on the ARMs, right?
Yeah, I'm glad you brought that up. That's exactly what I was just going to go into. So I won't get too technical, but I'm starting to see a shift up until like right now, just now in the last couple of weeks, months. An adjustable rate mortgage has not been a viable option for anybody, investors or homeowners, whatever. We've been on an inverted yield. Some of you may have heard me talk about this before. An inverted yield, this is post 0809, means that an adjustable rate mortgage rate was posting higher than a 30-year fixed mortgage. Zero incentive to want to take an ARM. That mechanism is starting to shift. We are going to start to see ARMs, adjustable rate mortgages, pricing lower, half a full percentage point below what a 30-year fixed rate would be, making it more mainstream again. And I'll tell you guys something, going back to the psychology of rates, people have a real problem wrapping their head around an adjustable rate mortgage. I talk to people all day long and they only want to consider a 30-year fixed mortgage. That's short-sighted, gang, and it's psychological, it's not factual. And I can say that because here's the data. This is the statistic. The shelf life of a 30-year fixed mortgage for an investment property is 5 years, maybe a little bit less. The percentage of individuals that start with a 30-year fixed mortgage on day one and make 360 payments later to pay it off is less than 1%. So don't be afraid of the adjustable. The adjustable will be our friend, especially for investors. Similarly with an interest only, I'm starting to see that those are probably going to be back in the mainstream soon as well, which will absolutely help improve our cash flows. I think that, I'll just get off on I'll go off on a tangent here just real quickly. We're at the precipice of a new cycle. Okay, all investment strategies have some kind of cyclical nature to them. I think that that's especially true for real estate, and we're at the start of the next. Housing prices are going to start to come down. The seller's market, and maybe I talked about this a little bit last week, the staunch seller's market that we've been living in is going to turn into a buyer's market. You need to be prepared right now today. Let's go back to harvesting equity, right? And that block that you have about interest rates and where they might be today. If you're prepared in advance to take advantage of what's coming next, and I promise you this is going to be prime for real estate investors, you're going to win over somebody that is sitting on the sidelines afraid to make moves because they haven't done the math and because they have this lack of information to make informed decisions based on real tangible numbers. So I would encourage everybody to really look at your portfolio today. Keep in mind what your short and long-term goals are, but be ready for the next wave because we're right there. We're real close. You're going to have a lot more negotiation leverage with sellers paying some of your closing costs. You're not going to be in a situation where you've got 20 people bidding offers on the same property. That's going to go away. You're going to be able to get properties at a cheaper price point. So let's look at it from that perspective. And this is healthy. This is all good stuff. Okay, you just want to be ready for it when it actually starts to turn. So if interest rates are going up, and they are, and probably will continue to go up, at least I would say through the summer months, maybe we see some cooling off coming in the fall, but stop focusing on the interest rate. And the point that I want to make here is that as the price points come down, interest rates are higher than they were. They may even continue to go a little bit higher. But if the price points come down, the mortgage that you're going to get is going to be less, right? There's going to be an offset there. It's not going to be you've got 6 and 7% interest rates at the same price points as that we've seen over the last 2 years, and they're going to continue to climb. No, those prices are going to start coming down. Be ready to take advantage of that because the two are going to offset. And all the while, what's going to be happening to rents as interest rates continue to rise? What happens to rents when rates rise? Rents will follow suit. They will not move at the same speed, but they will follow suit. And for those of you that aren't appreciating your rents now or haven't been for the last couple of years at just a very modest 2 or 3%, you've got the wrong property management company. I would encourage you to look around and see what else you can find. that will keep you up to speed with what you should be gaining in your monthly cash flows in your portfolios.
I think that's a healthy way to make sure that you're staying in touch with your property manager for your plans, especially well before leases come due, to make sure you've got the right tenants in there and everybody understands that things are increasing and we have to stay in touch with that. There is one question, Caeli, I want to throw out to you from Reverend Thorpe. But before we do, on that topic of pre-approval, I did want to just reinforce for everyone listening that Ridge Lending Group does offer an extremely strong way to become pre-approved. So we'll go through and Ridge will make sure that your income is reviewed, your assets, your credit. So literally you're just waiting to find that property. And as soon as you find that property, it's your hardest part is just getting the appraisal and title work done and insurance so that you can get ready for closing, because everything else has already been reviewed. So if you're not already pre-approved and you're on the hunt for a property, make sure you get a hold of a dedicated lending specialist if you don't have one already over at Ridge Lending, and they'll make sure you're set up and pre-approved. So the question, Caeli, was Reverend Thorpe has 2 houses that were purchased through their LLC with cash. One's already occupied and another one will soon be occupied. And so what are some answers for Reverend Thorpe on best loans to look at in terms of maximizing that opportunity?
Well, I'd want to take a little bit more information from you, sir, before I could advise appropriately, but I would start looking at how much can you leverage, right? And continue to keep at least at a break even for what you're going to have a tenant paying now. And how are we going to translate that harvested equity into more opportunity and more return? I sound like a broken record, you guys, but the math won't lie. We just will simply look at the portfolio, run the numbers based on several different scenarios. It doesn't just have to be one that we're going to look at. We'll look at it from a lower LTV perspective, or a conventional loan perspective, or a debt service loan perspective, or a line of credit, right? Maybe we look at the all-in-one that makes the most sense if you're the right candidate for that. Not a one size fits all. And I think that's especially true when we're trying to help borrowers, our clients, figure out how to cross the finish line of the goal, and then the next one, and then the next one. It's all very individual and customizable.
So does it change anything, Caeli, if each property is owned within its own LLC?
No, no, it does not. I don't know that that's my advice. I do have clients that come to us with something called, for those of you that aren't familiar, there's something called a series LLC, where you have the parent LLC and then every single individual property is held in its own LLC. So if they had 10 properties, there's 11 LLCs, 10 individual LLCs, and then you've got the parent LLC. This is a logistical nightmare, and I don't know, I have not had anyone convince me or be able to convince me that it is worth the additional asset protection I believe it's purposed for. I hate a series LLC for a variety of reasons, but no, it won't have any impact on what we would be doing, whether it be commercial or non-QM or conventional. Holding properties in an LLC isn't going to have any negative impact. Okay,
awesome. Thank you very much, Caeli. That was the end of that question. And as we wrap up here, I think the one part that I saw was a standout that I wanted to bring up was you're very welcome, Reverend Thorpe. Thank you for your question. So the one thing that jumped out at me, we have a client that is converting a piece of ground that they own, and they're using a 1031 exchange to turn that piece of ground that's worth some decent money right now, and they're turning that piece of ground into income producing assets now by taking that piece of ground and turning it into 4 or 5 different purchases, all through a 1031 exchange. And to me, that stood out as a huge win for the borrower. They're trying to figure out how to create income streams as they move through life. So, those are the kinds of things that stood out to me. I hadn't seen us actually do that much recently. Caeli, I don't know, is it 1031 considerably hard, or is it just rare?
No, it's very common in Ridge's world. Now, are they hard? I guess they could be if you're working with someone that doesn't understand the concept or the mechanics of a 1031 exchange. There's a lot of very, very hard and fast benchmarks, deadlines that you must hit in order to avoid the capital gains tax that you're going to have to pay if you sell a piece of property. But a very common practice for us. And I think that understanding which properties and when to 1031 exchange is something that a lot of our investors kind of struggle with, but certainly something that I can help advise on. There's some variables that we want to, check the boxes to see if that property is set for or appropriate for 1031 exchange that we can talk about on an individual basis. But 1031 exchanges do come with extra moving parts. But again, unless you're working with somebody that really doesn't understand the 1031 exchange, no, it's just a little extra T crossing and I dotting.
Okay, very cool, very cool. We have a last question. This will be the last one for today. And someone is curious about the best way to turn a current primary home into an investment property and then be able to purchase another home as an owner occupied, if there's a strategy or if there's some way to do it that doesn't cause a problem with underwriting or the loan is set up.
Yeah. So I love this. And we see our clients often trying to do the house hack where they'll purchase their primary, sometimes as a 2 to 4 unit where it's both an investment property and a primary residence all in one. I think that's a phenomenal strategy. But to the listener's point, it sounds like what they want to do is take their existing primary residence, make that a non-owner occupied, using rental income so that we can offset that mortgage payment, that departure residence mortgage payment, so that debt to income ratio on the new primary residence purchase is in line with the threshold or the max to qualify. There's some differences in underwriting guidelines if you're trying to use FHA as a means of qualifying. If your current primary was on an FHA loan, the new one can't be an FHA. So there's some strategy there that we're going to have to look at. Like anything, guys, it's very individual to your qualifications and what your big picture goals are. But yeah, we do that all the time where the individual is, and they don't want to sell their existing primary. They want to keep it as a rental. Maybe we look at tapping into the equity there first. Borrowed funds are non-taxable. They're going to use that to purchase the next primary residence. Lots of different ways that we can strategize about that.
So basically, if anybody has a thought about doing that, pick up the phone, give us a call, send an email in, and you'll figure it out.
Perfectly said.
Awesome. Well, last call for any questions. I don't see anything in. So I think today was an enormous resource. So I just want to refer back because we don't usually have an opportunity to explore for capital, access to capital. So SEED, SEED capital, Caeli, that's one example.
Correct. Mm-hmm.
Okay, cool. Awesome. Terrific. Well, thank you everybody for coming today. And as always, we appreciate it. If you have any questions, as we said throughout, if you want to make sure you get pre-approved or review your scenario specifically with Caeli or any of Ridge Lending Group's dedicated lending specialists, you can call 855-74-RIDGE or email over to info@ridgelendinggroup.com. Go ahead and follow the podcast, follow the YouTube channel, check out ridgelendinggroup.com's blog. Lots of articles. And of course, if you're not already part of the community, make sure you join the Ridge Lending Group community. Lots of great stuff in there too. So
thanks for being here, gang.
Thank you, everybody. Caeli, thank you very much. And have everybody, hope that everybody has a great week. Take care.